Stock is hovering right around $660 a share. I mean, it's been there for most of the morning after the earnings announcement. Stock hasn't moved in today's expiration date. So I'm going to go in and sell to open the 660 call option. I can't do that naked. I've got to protect myself by turning it into a spread. And if you're doing this one step at a time, you would buy the 665 call option first, right? And because the 660 is closer to the money, you'll get more money for that than the insurance. And so you bring in a net credit up here in this example of a $1.67, I think is what we brought in. And then I'm going to do the same thing down here by selling to open the 660 put. I really don't want to do that naked unless I've got a really big account and I'm interested in buying, $750,000 worth of stock. If not, I would simply go in and I would buy to open the 655 put option. I've created an iron butterfly. It's an at-the-money iron condor is all that is. And in this case, I brought in $1.40 credit on this side. Well, the two credits added together give me what, 307, something like that. So I've got $3.07 of credit that I brought in now. Now, I have risk in this trade. If the stock blows through one of my spreads or the other, right, if it goes all the way above 665 or if it goes all the way below 655, I could lose $5 on that spread. And I'm not going to be happy about that. So to mitigate that $5 loss, I brought in a $3 credit, which means that my risk in this trade is about $1.93. My reward is $3.07. Another way to look at it is this. If that stock goes $3.07 above 660 at expiration, or $3.07 below 660 at expiration, I could buy back the short leg of the trade that's got me in trouble for my credit, and I would not be in trouble, right? I'd be at break even, which also means that I've got a $6.14 landing zone where the stock can be in, and I'll be fine. I'll make some profit, or I've got some profit in the trade potentially if this thing stays between those two ranges. Does that make sense? Everybody with me there? Okay. $1.93 of risk, right? So since the stock just seems to want to hover there anyway, I might as well take advantage of that, sell the premium that's going to deteriorate through the day, and in this case that premium is pretty nice. I mean, that's $3. Price line's on a run now. All right. S&P might be finding some support down here, guys. DC Jim, I am doing the same, except I'm not running. I'm heading out here. So S&P is pushing lower here. Looks like they're trying to find some support around 2060. I don't see a lot of compelling reason for 2060. 2074 I see. 2040 I see. I don't know if we're going to get there today, guys, but the last, obviously we're through this little retracement right here, but the last low that we really put in on the SPX was right around 2040. I don't know if we're going to get there or not today, but I would say that we may see a sell-off to that range, and that's going to put us just above the 50 moving average. Ed says, it's true. Can't there be a lot of buy or sell on close orders that blow it up and you don't have a chance to close the in-the-money leg? Going into the close, so Ed, one of the things that I do on this, and I know several of the other students who trade this do, we might sell that for $3, let that thing go sideways for much of the day, and hour, 2 hours before expiration, we go back in and realize that this thing's trading at 2, right? Well, at that point, I'm just going to buy it back for 2, put $1.07 in the bank, right, to avoid that situation. But let's just say, worst case scenario, Ed, let's say that the stock blows up, you didn't do anything with it, and then like 30 minutes before the close, the thing blows up and it's up here, right? Well, that's going to suck, but how much is it going to suck, right? What is my risk in this trade? My risk in this trade is $5 minus 307, which is going to be $1.93. If I do this, and normally what I tell folks is do this in in small numbers, in small increments. One contract all the way through on this exposes you to 193 bucks of risk with the potential to make 307 if the stock pins to the 660 strike. The point is, very often, especially on a quiet market, you will see these stocks hover around a strike price for much of the day and the premium just bleeds out. And so you can buy it back later in the day, oftentimes at a pretty significant profit, and just get out of the way of that last 30 minutes of activity as the big funds are in, get in on the floor on Friday afternoon to try to position themselves for next week.